Welcome to One Touch Professional School. I pray we are all doing well. Great. We thank God for the gift of life and the opportunity to be part of today. We continue our discussions on Introduction to Management Accounting, paper 1.4. Today we are looking at chapter 8, and that centers on process costing. Great. What are we expected to know at the end of this session? Now, in our previous lecture, we're looking at costing methods, okay, where we looked at job costing. We've also looked at batch costing. Now, process costing is another form or method of costing, okay, good. And so this is a situation where the production is in a chain of series, okay? And so how do we cost such products, okay, where they go through several stages before they come out, okay? Process costing seeks to give us guidance and direction as to how costing under such circumstance could be carried out. All right. So let's start something and look at how process costing also works. All right. Now, process costing is the costing method applicable when goods or services result from a sequence of continuous or repetitive operations or processes. Process costing is used when a company is mass producing the same item and the item goes through a number of different stages. Okay, we are saying that process costing is used when a company is mass producing the same item and the item goes through a number of different stages. Process costing is an example of continuous operation costing. So where the operation is continuous in nature. Examples include the chemical, cement, oil refinery, paint, and textile industries. Now, in these industries, now the production goes through a series of stages. Okay, great. Now, one of the features, of process costing is that in most process costing environments, the products are identical and indistinguishable from each other. For this reason, an average cost per unit is calculated for each process. Okay, because the items are identical in nature and cannot be differentiated. Now, to determine the cost for a unit of a good or a product that has come out of a process, now it means that at the end of a given process, a number of units will come out. It is not just a single unit that will come out of the process. Okay, so how do we cost a unit of a product? We are saying that for this reason, the fact that they are identical in nature and not differentiable or not distinguishable, now the average cost per unit is determined for each process. So average cost per unit is given as the net cost of input. That is what is the cost of input, what's the cost of materials, labor, overheads that were placed into a particular process, or that were a process started with. Okay, good. So we take the net cost of input and divide it by the expected output. Now, expected and not actual, in the sense that we know that once it is a production process, it is not automatic. It is not 100% certain that whatever you put in will come out as finished goods. So there is some level of loss in the process, and so we are looking at expected output and not actual output, because it is premised on the fact that as the materials are put into the system, now a machine will use up some of the materials, okay, and therefore not everything will come out as finished product. Just like an example, if you send your maize or corn to the mill. Now, when it is milled, okay, you can see that the machine, okay, there will be some of the maize that will be stacked into the system. Okay, it is normal of the production process. Okay, and therefore not everything will come out as finished goods. Good. So there's an expectation that whatever you put in will not come out as finished goods. There will be some element of what wastage. Good. Good. Now, what are some of the features of process costing? What are some of the features of process costing? Now, expected output is what we expect to get out of the process. Okay, expected output is what we expect to get out of the process, just as I've explained. Another feature of process costing is that the output, okay, another feature of process costing is that the output of one process forms the material input of the next process, because we said that it goes through a series of stages. So as one stage ends, another begins. So the finished output of one process becomes the material input of the next process, and so on, until the goods get to its finished stage. Great. Now, the continuous nature of production in many processes means that there will usually be closing work in progress, which must be valued. Okay. Now, because the production process is repetitive in nature, because it is continuous in nature, because it is a continuous. Okay, we are saying that the nature of the production in many processes means that there will usually be a closing work in progress, which must be valued. In process costing, it is not possible to build up cost records of the cost per unit of output or the cost per unit of closing inventory, because production in progress is an indistinguishable homogeneous mass. We cannot determine the cost per unit in the sense that as the process goes on, there are a number of units in that process. It is not just a single product that is being processed, or it's not just a single product that's being produced. It is a number of units, and therefore it is not possible to determine the cost per unit. Okay, good. And the main point here is that we are saying that because it's a continuous process, now it means that at the end of the year, there may be some materials in the process that are yet to be converted into finished goods. And however, they might have gotten to certain stage of the production. Okay, hence the name work in progress. It means that it has not actually gotten to its final destination or its final stage, but it is being worked on. Great. There is often a loss in process due to spoilage, wastage, evaporation, and so on. Okay, there is often a loss in process due to spoilage, wastage, evaporation, and so on. Good. Now, output from production may be a single product, but they may also be a byproduct or byproducts and or joint products. Okay, good. We are saying that the output from the production may be a single product, but they may also be a byproduct. Okay, good, because there are times where when the production takes place. Okay, now there are instances where some products may not come up as standard. Okay, some may come up as substandard. Okay, and therefore we cannot sell it at the same price that we will sell the standard product. So those substandard products could be a byproduct of the process. Okay, we don't get it in whole, and therefore we cannot sell it at the price at which we sell them the actual standard product. Okay, good. So those fall out in the process, either a byproduct or they are joint products. Good. When there's closing work in progress at the end of one period, this forms the opening work in progress at the beginning of the next period. Great, because the process is continuous, and if a particular mass production have not been completed, we are saying that in the ensuing process, in the ensuing year, now that becomes the opening work in progress, which will be finished before any new introduction into the process. Great. Now, the details of process costs and units are recorded in a process account, which shows the materials, the labor, and overheads input to the process, and the material output at the end of the process. Okay, so we are looking at how the process account will be kept. So we are saying that the details of the process costs and units are recorded in the process account, which shows the materials, labor, and overheads input to the process, and the material output at the end of the process. Great. Great. Now let's look at the framework for dealing with process costing. The framework for dealing with process costing. Good. Now, process costing is centered around 4 key steps. Notes. Process costing is centered around 4 key steps. Now, the exact work done at each stage would depend on whether there are normal losses, scrap, opening, and closing work in progress. They're saying that the exact work done at each stage would depend on whether there are normal losses, scrap, opening, and closing work in progress. So the first thing to do, step 1, is to determine the outputs and losses. You need to find out whether in the production process there were any losses, okay, and therefore what will be the expected output of the process. The next is to calculate the cost per unit of outputs, okay, losses and work in progress, okay, because if there are losses in the process, is it normal, is it abnormal, okay, we need to value them, as well as the work in progress. That's the work that is still in the process of completion, and calculate the cost of output, losses, and work in progress. Then we complete the account. We complete the account. So basically, this is the process, okay, one would have to go through to get a process account done. So at this point, we are going to take some illustrative examples and run through to see how process costing works. Okay, good. All right. So let's see. Okay, so let's look at our first illustration. All right. So illustration 1, ABC Limited Manufacturing Company produces a product that passes through 3 distinct processes, after which it passes through the finished goods stock. So you have process 1 to 3. So 1, 2, 3. They have been given the input materials, that's the materials at the start of the process. Process 1, there were 800 materials inputs. Okay, 800 units of materials was put into the process. The material cost was 20,000. Labor costs that were incurred on the materials to convert it to finished goods was 30,000. Direct expenses was 14,000, and factory overhead costs incurred on this same unit is 16,000. Great. And at the end of the day, the output was also 800. Now, step 2, 400 materials were added, because what it means is that the beginning of step 2, okay, process 2 starts with the output of process 1, okay, and they added 400 to it. That's how come the output is 1,200, okay. Now the material cost added to process 2 was 17,000. Labor costs incurred on the materials added was 24,000, and direct expenses 11, and the factory was 12,000. Good. Then the next step is step 3, where additional materials added was 300, and therefore 1,002 plus 300 gives us 1,005. So here we are looking at a perfect condition where there are no wastages in the process, meaning that whatever that is put into the process comes out as finished goods. So here, there's the assumption is that there is no wastage in the process. Okay, good. Now, how do we go about this? Now, we are required to prepare the accounts for the various processes and ascertain the unit cost of each finished unit. Each finished unit. Good. So let's see. So we start with ABC Limited. ABC Limited. So I have process 1 account. Process 1 account. Process 1 account. Good. So we have input materials. So the first thing we start with is the materials. The unit is 800. Okay, the unit is 800. And then, hold on a minute. Try something here. Let me have the unit here. The unit of price. So we have materials. 800 was put into the system, and the total cost of material was 20,000. Okay, good. Now labor. So we add labor. And labor costs was 30,000. We add direct expenses. Direct expense of 14,000. Then we add our factory overheads, also, which is 16,000. Good. So that's process 1. So at the end of the day, we look at the units to the process, the total cost associated, and at the end, how many units came out. So whatever came out, that will be transferred to what? To the next process. So transfer to process 2 account. Transfer to process 2 account. And the total unit to be transferred is 800 because the output was 800. Good. Good. So now let's look at the total costs that were incurred in process 1. So I have 20 plus 30 plus 14 plus 16. That gives me 80,000. That gives me 80,000. So that's my 80,000. Good. Good. Now this 80,000 was the total cost for 800 units. So what's the unit price? So we have 80,000, okay, divided by 800, and that gives us 100. So the unit price of a unit is 100 Ghana cedis, and that gives us 80,000. Great. So at the end of the day, we close our accounts 800, and the total is 80,000. Good. Good. So this is how to go about the first process. Now, let's move on to process 2. Let's move on to process 2 accounts. So we have process 2 account. Good. So the first thing that comes here is what? The transfer. The transfer from process what? 1. Process 1 account. And how many units were transferred? 800 units. 800 units was transferred. At what price? At a price of 100, giving us a total of what? 80,000 Ghana cedis. Then we will add the materials, okay? The materials that were added. So materials introduced, the materials introduced in process 2. Additional materials of what? 400 was introduced. So we add that one. Now, what was the cost of the materials introduced? Now it is what? 17,000. That is 17,000. Good. That was 17,000. Good. Now we have labor costs. Labor cost incurred in process 2 is 24,000. 24,000. It's 24,000. Then we have direct expenses. Direct expenses of 11,000. Then we have factory overheads. Factory overheads of what? 12,000. Good. So we have transfer to process 3 accounts. And here the total units is now 1,200. Now what's the total cost? 80 plus 17 plus 24 plus 11 plus 12. That gives us 144. That gives us 144. Okay. 144. So the transfer to process 3, we're going to transfer a total of 1,200 units. Now, at what price? At what price? So 144,000, 144,000 divided by 1,200 units, and that gives us a unit price of 120 Ghana cedis, giving us 144,000. Great. So at the end, we have 1,200 units at a total cost of 144,000. Good. Good. So this is process 3. Sorry, this is the process 2 account. So now move on to the process 3 account. Move to process 3 account. So we have process 3 account. So you have transfer from process 2 accounts. The total unit of 1,200 was transferred at a price of 120, giving us 144,000. Good. And at process 3, 2 additional materials were added. So say materials. That is 300, and the cost of the materials was what? 12,000. That needs to be added. They have labor cost. Labor cost was 17,200. Direct expenses of 7,000. And your factory overheads. Of 5,800. Okay, of 5,800. Good. So at the end of the day, what is the total completed units? So we have 1,002 plus 300, that gives us 1,005. That gives us 1,005. So let's sum up. We have 144 plus 12 plus 17.2 plus 7 plus 5.8. So in total, get 186,000. 186,000. Good. So this is the final stage of the process. Whatever goods that are completed here goes into our finished goods account. So here we see transfer to finished goods. Transfer to finished goods account. And here the total completed units is what? 1,500 units. Now, what's the unit price of a unit? 186,000. What's the unit price? 186,000 divided by 1,500. That gives us 124. Okay, that gives us 124. So 124. So 124 times 1,500. That gives us our 186,000. Good. We have 1,500 at 186,000. Good. Good. So this occurrence is very rare, okay, in the sense that it is very scarce to find a situation where all materials put into a particular production process, everything comes out as finished goods. Okay, so this is where the machine is working under the perfect operating condition. Okay, good. So let's look at the finished goods account. The finished goods account, how would that look like? The finished goods account. Okay. Good. So we have the process 3, okay? Process 3. The output are coming out of process 3. The total unit is 1,500. It's a price of 1,886. Good. So that's about it. That's about it. Good. Good. So this is how the process account looks like. Good. Good. Now let's look at a situation where there are losses and gains in the process. Where there are losses and gains in the process. Good. Now, process costing with losses and gains. So first, we are going to talk about normal losses. Normal losses. Now, sometimes in a process, okay, the total of the input units may differ from the total of the output units. Now, why? This is as a result of the following. Now, losses may occur due to the evaporation or wastage of materials, and this may be expected, and this may be an expected part of the process. Okay, good. 2, losses may sometimes be sold and generate a revenue, which is generally referred to as scrap. Okay, losses may sometimes be sold. Okay, losses may sometimes be sold. Okay, and generate a revenue, which is generally referred to as scrap proceeds or scrap value. Good. Now, normal loss is the loss that is expected in a process, and it is often expressed as a percentage of the materials input to the process. Okay, good. So, as I said earlier, it is not practical, it is not normal, okay, that all units put into the process will come out as finished goods. Okay. Now there are instances, okay, where the materials put into a process, okay, not everything will come out as finished goods, and that is as a result of losses due to evaporation, wastage of materials, among other things. And those are an expected part of the process. These are expected in the process. Okay, good. Now, there are also instances where these losses may be sold and therefore will generate some amounts, okay, from the sale, which is termed as a scrap proceed or a scrap value. Okay, good. And we say that normal loss is the loss that's expected in the process, and it's often expressed as a percentage of materials input to the process. Great. Great. So let's look at a situation where there's normal loss, and the normal loss can be scrapped. We can sell the loss in the process for an amount. Good. Now, if normal loss is sold as scrap, the revenue okay, the revenue from the process, is used to reduce the input cost of the process. If normal loss is sold as scrap, the revenue is used to reduce the input cost of the process. That is A. If normal loss is sold as scrap, then the formula for calculating the average cost of the units, okay, the average cost of the unit output does not really change if normal loss is sold as scrap. When the sold as scrap, then the formula for calculating the average cost of unit output does not really change. Now, simply the cost of the inputs are reduced by the revenue received from the scrap that is sold, that is given the net cost. So here, the average cost per unit will be determined as the net cost of input over expected what? Output. And the net cost, basically, that can be broken down as total cost of input minus scrap value of normal loss, okay, all over input unit minus normal loss what? Unit. Okay, good. Then B, if the normal loss has a scrap value, it is valued in the process account at day's value. Okay, if normal loss has a scrap value, it is valued in the process at day's what? Value. If normal loss does not have a scrap value, its value in the process account is what? Nil. It's nil. Okay, it's nil. Good. So there are instances where the normal loss in the process cannot be scrapped, and therefore you will not assign any value to it. Okay, good. You will not assign any value to it. Okay, good. So let's look at that. Let's look at an example, illustration 2, to see how, where there are losses in the process, how that affects our work. Okay, good. So a company incurred the following costs in a process. We have material introduced, that is 1,000 kg. The material cost was 30, direct wages is 32, overheads is 12,000. Normal process loss is 10% of material input. Okay, normal loss in the process is what? Is 10% of material input. Good. Now, what are we to determine? Calculate the cost per kg of good production and prepare the process what? Account. And prepare the process account. Here we are to determine the cost per kg of good production and prepare the process what? Account. Okay, so let's look at how this will be done. So the first requirement is for us to calculate, so cost per kg of good production. So let's look at the cost per kg of good production. Okay, cost per kg of good production. Good. So here we have the units and the amount. Okay, good. And here the unit is in kilograms. Good. So let's look at materials. What's the material cost? The materials, how many inputs was 1,000. Okay, at a cost of what? 30,000. Then we add direct wages, which is also what? 32,000. It's 32,000. Then we have our overheads. Which is 12,000. Good. So at the end of the day, okay, let's look at, we have a total of 1,000. We have a total cost of 30 plus 32 plus 12. That gives us 74,000. Good. So assuming there were no normal loss, then we are saying that the total cost of cost per kg of good production would simply have been 74,000 divided by 1,000. Okay, assuming there's no loss in the process, then to determine the cost per kg of good production, it is the cost of 74,000 divided by what? 1,000. Good. But here we're told that the normal loss, the normal process loss is 10% of material input. So we determine the what? The normal loss. So let's see, normal loss is 10% of materials. So what is 10% of 1,000? So 1,000 times 10%, that gives us what? 100. That gives us 100. Good. So that comes out of the what? The input. Now here, it cannot be scrapped. The normal loss cannot be scrapped. We are not told anywhere in the question whether normal loss can be sold for something or not. So it means that here it is nil. Good. Great. So here we get the expected what? Output. We get the expected output. The expected output of the process, because if the normal process loss is 10%, then it's expected when we put in 100, we get 90%. Okay, good. So here we get 900 kg, and that 900 kg would have to be valued at what? 74,000. Now, instead of spreading the cost of 74 over 1,000 units, because that's what we put in now, not all the units came out as finished goods, and the scrap value cannot, the units or the loss in the process, can also not be what? Sold. We cannot sell the loss in the process. So what it means is that we must find a way to attribute the total cost of 74,000 to the expected output, or to the good unit that came out of the process. Okay, so that the company does not suffer a loss. Okay, so we must find a way to cost the 900 units at the same value that we have assigned to the 1,000 units. Okay, because if you don't do that, if you don't absorb the cost of the 100 units into the remaining 900 units, now it means that that cost will become an expense to us, but we need to recover that cost. So we need to value the good production or the good unit at the same cost as the cost for the total unit. Good. So let's look at the cost per unit here. So value per, or cost per good production, cost per kg of good production, or cost per, so let me see, cost per kg of good production is equals the total cost of 74,000, okay, divided by the expected output of 900. So that gives us what? 74,000 divided by 900. That gives us 82.222 recurring. Okay. Great. So this is how we go about determining the cost per kg of good production. So always it is the input into the process. That if there's any loss, you deduct the loss from the units that were input into the process to get your expected. If the normal loss were to be scrapped, then the scrap value would have been deducted from the total cost, because when we sell the scrap, we will get something. So that should come to reduce the total cost of the 1,000 units. Okay, good. So that at least the 900 units that comes from the process will not be overpriced. Okay, because 100 is a loss. Now we have assigned the cost of the 100 to the remaining 900 units. So that will cause the unit cost to be high. Okay, good. But where the normal loss can be scrapped, at least we can use the scrap value to reduce the total cost, so that the remaining unit wouldn't be that overpriced. Okay, good. Now, after this, we're to prepare the process account. We have to prepare the process account. So let's look at how this one will look like. So we have the process account here. So we have our units of the price, the amount, the units, the price, the amount, or totals, as you may call it. Good. So let's see. The unit is in kg. So kg. So we have the materials introduced. The materials introduced. That is 1,000. That is 1,000. Good. And that is at a cost of 30. Then direct wages. Direct wages is 32,000. Overheads is 12,000. Overheads is 12,000. They have a normal loss. Normal loss of 10%, which give us 100. Now this cannot be scrapped, so it's at a nil value. Now at the end of the day, our outputs out of the process or finished goods, okay, our finished goods out of the process was 900, and this 900 is going to be valued at what? 82.222 recurring. So leave it at that. So our total units is 900 here at a total cost of what? 74,000. So at the end of the day, our total cost me 1,000. Now what is 900 times 82.222? Okay, good. So here you get 73,999 Ghana cedis, 98 pesos. So approximately 74,000. So 74,000. Good. So about 74,000. Good. So this is how it works, where there's a loss in the process and the loss cannot be scrapped. Now we cannot assign any value to the scrap value because we cannot sell it. We cannot realize anything from the sale. Okay, we cannot realize anything from the sale. So we leave it like that. Good, good. So this is the process account where there's normal loss, but the normal loss is not scrapped. Good. Now let's look at the next example. The next example. Okay, so you try your hands on question 3. Let's look at example 4. Let's look at example 4, where the loss in the process can be scrapped and how that affects our computation. Good. Now, Cadman Limited incurred the following cost in the process. We have materials introduced 1,000 kg. The cost of the materials 45. Direct wages incurred was 48,000. Overheads is 18,000. Normal loss is 10% of material input, which will be sold at 30 Ghana cedis per kg. So it means that the loss in the process, okay, can be sold for what? 30 Ghana cedis per kg. Required. Calculate the cost per kg of good production. Calculate the cost per kg of good production and prepare the process account. Calculate the cost per kg of good production and prepare the process account. Good. So let's see. So we have Cadman Limited. Great. So first, let's determine the cost per kg of good production. So cost per kg of good production. So we have the units and the amount. kg. So we have materials into the process, which is 1,000 kg. It's a price of 45,000. The price of 45,000. We have direct wages of 48,000. We have overheads of what? 18,000. Good. So at the end of the day, we have total of 1,000. The total cost is what? 45 plus 48 plus 18. That gives us 111,000. Good. Now let's deduct the loss, the normal loss. The normal loss is what? 10%. So 10% of 1,000 is 100 kg. Now this normal loss can be scrapped at what? 30 Ghana cedis per one. 30 Ghana cedis per one. So what you are saying here, why normal loss can be scrapped? We should use the revenue from the sale of the scrap to reduce the total cost. Good. So here we have 100 times 30. That gives us what? 3,000. Okay. So we're going to deduct this and its associated cost, the revenue from it. Good. Good. So now our expected output or good production, our expected output of good production is 900, okay, at a cost of 111,000 minus 3,000. That gives us 108. That gives us 108,000. Okay, good. So the cost per good production, the cost per good production, or cost per kg of good production, because 108,000 divided by 900. So that gives us 120 Ghana cedis. That gives us 120 Ghana cedis per kg. Per kg. Good. So I hope you are following. Good. So at this point, if the loss can be scrapped, what we are saying is that the amount of revenue coming in from the sale of the scrap should be used to reduce the total cost. So at least the cost for the expected or the good production is not overstated, okay, or it's not overpriced, because ordinarily the cost of 1,000, you are now assigning the cost to 900 units. So the per unit cost will obviously be high, but if there's something coming in from the sale of those materials that have gone waste, now at least we should use the revenue from the sale of the scrap to reduce the total cost. Okay, good. So now let's look at how the process accounts will be prepared. The process accounts. Okay, so you have materials. You have 1,000. Materials, you have 1,000. at a price of 45,000. We have direct wages of 48,000. We have overheads of what? 18,000. Great. Then we have our normal loss. A normal loss in the process of 100 kg. Now this can be sold for what? 30. So this time around, it is not a nil value. Its value is 30 Ghana cedis. Good. And that give us 3,000. That gave us 3,000. Good. Then the transfer to the finished goods. So finished goods in the process is 900. And that 900 is valued at what? 120 Ghana cedis. 120 Ghana cedis. So 900 times 120 gives us 108,000. Good. $1,045 plus 48 plus 18. That gives us 111. 1,000. That gives us 111. Great. So this is how the account will look like. So where there is a loss in process and the loss can be scrapped, or the normal loss can be sold, and we are saying that the revenue from the sale of the normal loss or the units that went to waste should be used to reduce the total cost. Okay, good. So that is that. Now let's look at where there are abnormal losses and abnormal gain. That is where the loss expected, okay, it's not the case, or we get a loss which is bigger than expected. Okay, good. And where there is an abnormal gain, that's a gain which is not expected, but then it has arisen. Okay, how do we treat it? Good. Now, normal loss is expected loss in a process. If the loss in a process is different to what we are expecting, okay, if the loss in the process is different from the expectation, what do we do? Then we have an abnormal loss or an abnormal gain. Then we have an abnormal loss or abnormal gain in the process. Abnormal loss is more loss than expected, and abnormal gain is less loss than expected. So there's a gain when there's less loss than what's expected. Good. Now, how do we treat abnormal losses and gains, and how does that affect the process account? Now, the costs associated with producing abnormal loss or gains are not absorbed into the cost of good output. The costs associated with producing abnormal losses or gains are not absorbed into the cost of good output. Abnormal loss and gain units, okay, the abnormal loss and gain units are valued at the same costs as the unit of good output in the production process. So here, we are not going to absorb the cost of abnormal gains or abnormal losses. Okay, good. We are saying that the abnormal loss gain or units, abnormal gains or loss units are valued at the same cost as the unit of good output in the process account. Good. Now let's try and explore more on abnormal losses and gains. So we've come to establish that abnormal loss is more loss than what's expected, and we get an abnormal gain when we get less loss than what's expected. Good. We have also come to establish that in the case of abnormal gains and abnormal losses, now its cost will not be absorbed into the good unit. However, they will be valued at the same price as the good unit. Good. Now, losses and gains are transferred from the process account to the abnormal loss or abnormal gain account. If there is no scrap value, The losses or gains are transferred to the statement of profit or loss at the end of the process account. So once there is an abnormal loss, once there is an abnormal gain, we need to open an account for them, and we transfer those losses and gains to their respective accounts. Good. Then at the end of the day, the difference sitting on those accounts will be transferred to the profit or loss account. Good. If there's a scrap value, for the abnormal loss and abnormal gain, now how do we treat it? We are saying that the abnormal loss is transferred from the abnormal loss or gain account to the scrap account at the scrap value. So in the abnormal loss and abnormal gain account, there can be scrap. Then we transfer the loss from the abnormal loss or gain account to the scrap account at the scrap value. The cost of the loss transferred to the statement of profit or loss is reduced by the scrap value of these loss units, and cash received for scrap sales is increased by the sale amount. The abnormal gain is transferred from the abnormal loss or gain account to the scrap account at the scrap value. The saving associated with the gain is transferred to the statement of profit or loss, but it also reduces the cash received for the scrap sale. Okay, good. Suggested approach for answering normal loss, abnormal loss, and gain questions. Good. The first is to calculate any normal loss units, draw the process account and enter the unit of, or produce a flow of units. That is, input unit equals output unit. The balance figure for the unit is either an abnormal loss or abnormal gain. Then what do? You value the inputs, you value the normal loss, if any, you calculate the average cost per unit, then you value the good output and the abnormal loss or gain at the same average cost per unit. You transfer the normal loss to the scrap account, if any. You transfer normal loss or gain to the abnormal loss or gain account, respectively, and you transfer the abnormal loss or gain to the scrap account at the scrap value, if any, and you balance the abnormal loss or gain account and the scrap account. Good. Note. Abnormal losses and gains never affect the cost of good unit of production. The scrap value of abnormal loss is not credited to the process account, and abnormal loss and gain units carry the same focus as the good unit of production. Great. Now, losses with a disposal cost. Now, the calculation required in such an instance is as follows. Okay, good. So we'll come to that later if there's anything like that. So let's look at illustration 5. Illustration 5. Okay, good. How do we go about this? Now, Emerald Limited incurred the following costs in the process. We have material introduced 2,000, the cost, material cost of gain, direct wages and wages. Normal loss is 10% of material inputs. Actual output was 1,700. Required, calculate the cost per kg of good production, prepare the process account, prepare the abnormal loss account. Good. Now let's look at how we go about this one. Good. So we have Emerald Limited. Good. So A, requirement A, C, we should calculate the cost per kg of good production. So you have the units, you have the amount, you have this kg. Good. So now let's look at the materials introduced. So the materials put into the process was 2,000 kg at a cost of 37,500. We have direct wages of 40,000. We have overheads of 15,200. So at the end of the day, we have 2,000. The total cost of this 37,500 plus 40,000 plus 15,200. That gives us 92,000 700. Good. The loss in the process, the normal loss is what? 10%. So 2,000 times 10%, that gives us 200. Okay. Now, were we told whether the value can be scrubbed? No, there was nothing like it can be scrubbed. So it is nil. So that is dash. So the expected output is what? 1,800. It's 1,800. But the actual output from the process, the actual output from the process, the actual output from the process was 1,700. Okay, was 1,700. So that should tell us that if we're expecting a unit of 1,008 and now the actual is 1,700, there has been what? An abnormal what? There has been a lot, an abnormal loss of what? 100. That's a loss that we were not expecting. It is an abnormal loss of 100 what? Units. Good. Good. Now, let's look at the cost per kg of good production. The cost per kg of good production. The cost per kg of good production. So here, our cost per kg of good production is equals to the expected cost, okay, which is the 92,700 divided by what? The expected output of 1,800. So that gives us 92,700 divided by 1,800. So that gives us 51 Ghana cedis, 50 pesos. Good. That gives us 51 Ghana cedis, 50 pesos. Wait. So you can see that here, even though there was an abnormal loss, now we didn't value the total cost, or we didn't value the actual output, but rather valued the expected, because that loss in the process was a loss that we were not expecting. And so from our theory, we did mention that the abnormal losses or gains will be valued at the same unit as the what? The expected what? Output. Okay, great. However, if at a later date, the abnormal losses or gains can be sold, then we are saying that the amount realized from the sale will be used to reduce those balances in their respective accounts. Good. So now let's look at how we go about this. Okay, great. So we have our process accounts. Great. So materials is materials. We have 2,000. 2,000 into the process at a cost of 37,500. We have direct wages of 40,000, of overheads 15,200. Okay. And you have what? Normal loss. You have normal loss of a normal loss of 200 at a nil value. So you have the abnormal loss of 100 at a price of 51.50 pesos. You have the finished goods stock, finished goods of 1,700. Finished goods of 1,700 at a price of 51.50 pesos. Okay. Good. So what do we get? Now 100 times 51.50 pesos. That gives me 5,150. And 1,700 times 51. 1,700 times 51.50. That gives me 87. 87,550. Good. Good. So you have 2,000 at a cost of 92,700. That will get 2,000 at a cost of 92,700. That is 87,550 plus 5,150. Great. Great. Now let's open our abnormal loss account. Let's open our abnormal loss account. Let's open our abnormal loss account. This is the abnormal loss account. So here we have the units, the kg, and we have the amounts, the totals, the Ghana cedis, units in kg, cedis. Good. So you're in the process account. The normal loss has been credited. Is that not it? So we debit it here in the name of process, the process account. And here the unit is 100. It's 100 units. And the value is 5,150. Okay. Good. 5,150. Great. Good. So at the end of the day, now here we're not given or we're not told whether the scrap or the abnormal loss can be scrapped. Okay, good. So at the end of the day, the total of this will result in a loss P&L of 5,150. Okay, or 5,150. Good. So at the end of the day, this is how the normal loss account will look like. And here it is the loss that we are after. We are not after the unit, we are after the value of the loss. Okay, good. Good. So this is how abnormal loss is accounted for. That is where the abnormal loss cannot be scrapped. Okay, if it were to be scrapped, then what we are saying is that the value realized will be used to reduce the loss. So we credit this account to scrap and go and debit scrap. Okay, good, good. All right, all right. So let's see. let's look at our next illustration. Let's look at our next illustration. So let's look at illustration 6. Let's look at illustration 6. Great. Illustration 6. Now, the following costs were incurred in the production of a product by Mavis Lincoln Limited in a process cost center. We have materials. The input unit is 1,250 units at a cost of 50,000. Direct wages 30. Production overheads is 15,625. Normal loss is 10% and has no scrap value. During the period, actual loss was 250 units. During the process, the actual loss in the process was 250 units. Required. Calculate the cost per unit, prepare the process account, and prepare the abnormal loss account. Good. So let's look at this one too. Let's look at this one quickly. So that is Mavis Lincoln Limited. Okay. Now the A is for us to determine the cost per unit. Okay, so we have our units, the amount. Okay, let me see. Now here too, you can see that the normal loss cannot be scrapped. Okay, good. So it's the same as the first one. Okay, it's the same as illustration 5, where the loss cannot be scrapped. So let's look at a situation where the loss in the process can be scrapped. Okay, that's a bit different. So that will take us to Bosu Limited. Let's use that one instead. Because once the value cannot be scrapped, it will just be the same as the first one. So we shouldn't waste time there. Let's look at where the loss can be scrapped so that we see the difference. So you can try the question 6 on your own. So we have Bosu Limited, that's 7, question 7. Okay, good. So that one to the requirement is calculate the cost per unit, prepare the process account, prepare the abnormal loss account, the scrap account. Great. So this is a bit different. Good. So let's see materials. The input is 1,000. The cost is 60,000. We have direct wages of 64,000. We have overheads of 24,320. Okay, good. So at the end, we have 1,000, and the total cost of 60 plus 64 plus 24. So that gives us 148,320. Good. Now, the normal loss in the process. So let's look at our normal loss, which is 10%. So 10% of 1,000 is 100. Now, this can be scrapped. Say that normal loss 10% material inputs and can be sold at 30 Ghana cedis per kg. At 30 Ghana cedis per kg. Good. So 100 times 30 Ghana cedis, that should give us 3,000. Okay, good. So our expected output, okay, was 900 at a total cost of 145,320. Good. But was the expectation the actual? No. So our actual output from the process was 850. Now that should tell us that there was additional loss of what? 50. That's an abnormal what? Loss. It's an abnormal loss. Good. So how do we determine the cost per kg of good units? So the cost per unit, as you have already explained, abnormal losses and abnormal gains are valued at the same average price per unit of the good what? Production. Good. So our cost per unit will be equal to the total cost or the net cost, which is the 145 because we've deducted the abnormal loss from it. Sorry, the normal loss from it. So 145,320 divided by the expected output, that is what? 900, because the abnormal loss is something that is expected. Okay, good. So we have 145,320 divided by 900, and that gives us 161 Ghana cedis. Let me say 47 pesos. Good. So that's the cost per unit of good what? Production. The cost per unit of what? Good production. Now, what's the next thing to look at? Now, the next thing for us to look at is the what? To prepare the process account, the abnormal loss account, and the scrap what? Account. Good. Good. So let's look at how we're going to go about that. So this is the process account. So we have materials. Our materials is what? 1,000. Okay, at a cost of 60. We have direct wages of 64,000. We have overhead costs of 24,320. We have our normal loss of 100. Comes graph at 30, giving us 3,000. We have normal loss in the process of 50, and that is valued at good production, or the cost per good unit, that is 161.47. Then we have our finished goods, which is 850, valued at 161.47 as well. Good. So let's look at the values that we have here. Now, 50 times 161.47, that gives us 8,074. Then 850 times 161.47, that gives us 850 161.47, that is 137 250, 137 250. So let me see. Okay. So because of the rounding, there may be some slight differences here. Okay. So let me see 50 times 1, 6, 1.47. 161.47 times 50. Okay, great. So at the end of the day, let's look at, so our total is 12,000 units at a total of what? 148, 320. 148, 320. So it's 1,000, 148, 320. Okay, good. Good. The next thing for us to do is prepare the what? The abnormal loss what? Account. The abnormal loss account. So let's see. And the abnormal loss account. And the units, the price, and the amount. The units, the price, and the amount. Good. Good. So that's the KG. So if you look at our process account, okay, abnormal loss, we have for process account, the unit there is 50, okay, valued at 161.47, okay, that gives us what? 80.74. Okay, good. Good. Now, we're told that, or we learned that where the scrap value, okay, so where the abnormal loss can be scrapped, okay, now that should be used to reduce the what? The loss. Okay, good. So here, the abnormal loss can be scrapped at 30. Say that normal loss is 10% of material input and can be scrapped at 30 per kg. So all losses in the process, unless different prices are assigned. So what it means is that we have some scrap value, or some scrap, or normal loss account. Okay. The scrap slash the normal loss account, and here the 50 units can be scrapped for 30 cedis, and that is what 50 times 30. That should give us 1,500. That should give us 1,500. So we can realize 1,500 from this. Okay, abnormal loss. We can realize 1,500. So the difference goes to the P&L, which is 50, 80.74. So at the end of the day, so 50, and the loss in the process 80.74 minus 1,500. That gives us 6,574. So we have 80.74. Great, great. So this is how the abnormal loss will look like. the total loss is 8,074. However, this loss or this abnormal loss unit of 50, we can sell it for 30 cedis per unit. So that gives us what? 1,500. So the 1,500 comes to reduce the amount of loss. Good. Now let's look at the scrap account. The scrap account. The scrap account. Okay, so the scrap account. Now we have our normal loss. Okay, we have the normal loss. So scrap account is the same as the normal loss account. So process accounts. Our normal loss was 100 at 30, giving us what 3,000, right? Good. And now we have the abnormal loss. Now we have credited the abnormal loss account, the name of normal loss or scrap account. So that comes here. That's abnormal loss account. We have 50 at 30, giving us 1,500. Okay, good. So this represents the total amount realized from the sale of the losses or the wastage in the process. Okay, good. Now at the end of the day, the amount in here is sent into our bank account. It is either they have paid for or they are in receivables. Okay, so we say bank / receivable account. Okay, good. So at the end of the day, we are interested in the value of that's 4,500. 4,500. Okay, good. Great. So that is the scrap account for you. That's the scrap account. Okay, good. Now, any questions here? If you have any question, note them down in our interactive section. We'll take a look at them. All right. So now we've demonstrated how losses in the process will be handled. Now we know that normal loss is something that is an integral part of the process, and therefore, if the normal loss can be scrapped, the scrap value is used to reduce the total cost of the inputs, and therefore the expected output is valued at a reduced cost, which is the total cost less the scrap value of the normal loss. Good. However, where there's an abnormal loss or abnormal gain, they are saying that those are not expected, and therefore they are valued at the average cost per unit of the good production. However, if they can be sold for something small, that value is used to reduce the loss. Okay, good. And a typical example is what we have looked here. Now I can see that the abnormal loss was valued at the cost of good production, 161. However, the loss could be sold for 30, and therefore we use that proceed from the sale of the 30 to reduce the amount of loss. Okay, so the amount that will be transferred to P&L is a reduced loss. Okay, good. Then we opened our scrap account. This is an account more or less like a revenue account. Okay, good. So the total amount received from the sale has been debited to the scrap account, and now that amount will be sent to our bank. Okay, good. Now let's look at some further examples. Let me see illustration 8. Okay, the question 8. We have 1,000, 10%, that would be 900, and we have 920, Okay, so to prepare the loss account. Okay, so let me look at illustration 9, which is more comprehensive in nature because you have two processes. This is just one. So let me look at a situation where there are two process accounts and how that affects the computation. Okay, good. So let's look at this question instead. That's more comprehensive. Okay, that's more comprehensive. Good. Then from here, we'll look at the concept of equivalent units. So let me look at illustration 9, which is more complex. Then take it from there. Good. So we have Baku Company Limited. We have Baku Company Limited. Okay, good. So Baku Company Limited has a factory that operates two processes. Normal spoilage is expected to be 10%, and scrapped units from process 1 are sold at 1 cedi per unit, whereas scrap units from process 2 are sold for 60 pesos per unit. The data below relates to cost information gathered from Baku's process 1. We have material inputs 3,000 at 8 kg, giving us 24. We have additional materials introduced 1,875 kg at 3 cedi, that's process 2. We have labor and overhead cost to be 30, and output in units. That is process 1 gave us 2,625, and process 2 gave us 4,200. The output from process 1 is transferred to process 2, and output from process 2 is finished output, ready for sale. Required, prepare process 1 and process 2 account, the scrap account, and abnormal loss and gain account. Good. So let's look at this. Good. Let's look at this. Now, let's look at process 1 account. So I have my process 1 account here. So the units, the price, the amount. The units, the kg, the price, this, the amount. So this, okay, good. So process 1, let's see. The materials put into the process. So materials, process 1 was 3,000 kg at a price of 8, giving us 24,000. Then we have labor and overheads. Labor and overheads cost of what? 30,000. Okay, good. Then we are saying that output in units is 2,625. Okay, so let's do some short workings here. That is the cost per good production. Good cost per kg of good production. Amount here, the units, kg. So we have materials, okay, to be 3,000 at a total cost of 24,000. We have labor and overheads to be 30,000. Great. So at the end of the day, we have 54,000. Total unit is 3,000. Normal loss is what, 10%. So what is 10%? 3,000 times 10%. That is 300. Okay, and we're saying that loss in process one can be scrapped at what? 1 cedi. The scrap unit from process one can be scrapped also at 1 Ghana cedi. So that gives us 300. Okay, the units 2. So we're expecting 2,700 units, and the expected cost is 700. That is 53,700, right? Good. However, actual output from the process. So this is the expected output. And the actual output from the process was 2,625. So the difference, 2,700 minus 2,625, that gives us an abnormal loss of what? 75. That gives us an abnormal loss of 75. Great. So we come here, come to our process account. We have our normal loss. Normal loss of 300 at 1 cedi. At 1 cedi. Minus 300. We have abnormal loss of 75 at the cost per good production. What's our cost per good production? Okay. So cost per unit becomes 53,700 divided by 2,700. So what do we get? 53,700 divided by 2,700. So that gives us 19 Ghana cedis. 8888. It's recurring. Okay, good. So this will be valued at 19.88. Okay, then the transfer to process to accounts. Transfer. So there's a transfer to process. That is 2,625. Okay, good. Also at 19.88. So let's see at the end of the day. End of the day. 75. So 75 times into brackets 53,700 divided by 2,700. That gives us 1,491.67. Then we have 2,625 times into brackets 53,700 divided by 2,700, and that gives me 52. That gives me 52,208.33. Okay, good. So this gives us 3,000, and this gives us 54,000. 3,000, and that gives us 54,000. Great. So this is how we go about the process one. We go about the process one. I hope you are all together. Good. Good. So it's the same process. Good. Now let's move on to process two. Let's move on to process two, accounts. Let's move on to process two. Good. So this is our process two. Process two, accounts. So for process two, accounts, so the units of the price, the amount, price, the units. So it's kg, good. So yeah, we say transfer from process one. The transfer from process one is 2,625 at a price of 19. The price of 19.88. That gave us 52,208.33. Okay, good. Then we have materials introduced. Materials introduced. The material introduced was 1,875 at a price of 3 cedis, and that gives us 5,625. Okay, then we add labor and overheads. The one overhead cost was 40,000. Okay, great. Now let's look at our cost per good production. Let's look at our cost per good production. So cost per kg of good production. Okay. So we have the units, kg, we have the amount, the cedis. So we have transfer from process one. Transfer total of 2,625 at a cost of 52,208.33. The materials added to the process. Materials introduced was 1,875 at a value of 5,625. Okay, we have labor and overheads of 40,000. Okay. So total input into the process 2,625 plus 1,875. That gives us 4,500. So 52,208.33 plus 5,625 plus 40,000. That gives us 97,833.33. Good. Now, normal loss is 10%. So 4,500 times 10%. That gives us 450. And this can be scrapped at 0.60. So 450 times 0.60. That gives us 270. So this reduces that. So 4,500 minus 450. That gives us 40 and 50. That's a cost of 97,833.33 minus 270. That is 97,563.33. Okay, then the actual output from the process was 4,200. So we have an abnormal gain of 4050 minus 4,200. That gives us an abnormal gain of what? 150. Okay, that gives us an abnormal gain of 150. Good. So how does this affect our process account? How does this affect our process account? Good. Now, at the end of the day, there is the need for us to determine our cost per unit. Cost per unit. Here we have 97,563.33 divided by 40 and 50. So 97,563.33 divided by 40, 50. That gives us 24 points. 24 points. That gives us 24 points 09. Okay, good. 24.09. So let's quickly look at our process account. So here we have our normal loss of 450 at 0.6 minus 270. Then here we have an abnormal gain. So come here and say abnormal gain of 150, and that will be valued at 24.09. Okay, 24.09. So here we have the normal loss. Okay, good. So we have finished goods. The finished goods. The finished goods was 4,200. Good, and that can also be valued at 24.09. Okay, good. So let's see. We have 150 times into brackets 57. So 97,563.33 divided by 4050. Okay. That gives us 3,613.46. Okay, good. 4,200 times into brackets 97,563.33 divided by 4050. And that gives us 101. 101. 101. 176.79. Great. So at the end of the day, let's see. So we have 2,625 plus 1,875 plus 150. That gives us 4,650. And the total was 52,208.33 plus 5,625 plus 40,000 plus 3,613.46. So that gives me 101,446.79. So this also gives us 4,650 at a total cost of 101,176.79 plus 270. That gives us 101,446.79 as well. Great. So now we have to open our scrap account, then abnormal loss and abnormal gain account. Good. So let's quickly look at them. Good. So let's look at our scrap account. Slash normal loss account. Okay. Units, price, and the amount. Okay. The amount here, the price, the units. Good. Okay. Let me open the abnormal loss account. The units, the price, and the amount. Price, units. Okay. Great. So let's see. Okay, let me add the last one. That's the abnormal gain account. The abnormal gain account. And the units, the price, and the amount. Okay, sorry about that. Of units, of price, of the amount. All right. Good. So let's see. We have abnormal gain in process 2 of 150. So the process was debited. So we have to credit the abnormal gain account in the name of process 2. Okay, the unit was 150. It was valued at 24.09. That gives us value 3,613. 3,613.46. Great. And there was abnormal loss in the first process. Abnormal loss of 75 at 19.88. So that one we debit. That's process. This process 1 account of 75 at 19.88. Okay. So 75 times 1,491.67. Okay, good. That's a normal loss. And we're told that normal loss in process 1 can be scrapped for 1 cedi. So the scrap value for this is 75 at 1. Okay, doing as 75 cedis. Okay, so we come to the scrap account. Where's our scrap account? Come to the scrap account. Debit it with abnormal loss. 75 at 1. 75 cedis. Okay, great. So it means at the end of the day, here the loss, the amount that will be transferred to P&L will be 1491.67. 1491.67 minus 75. That gives us 1,416.67. 1,416.67. Okay, good. In terms of the abnormal gain, now the abnormal gain too can be scrapped. Okay, so you come here, can be scrapped. So that's kg. So you have scrap. The value is 150 at 0.60. So 150 times 0.6, that gives us 90. Good. So it's a gain. So here the difference goes to P&L. Okay. The difference goes to P&L. Don't forget that here you are interested in the value of the gain. So we have 3,613.46. 3,613.46 minus 90. So the amount that will be transferred to P&L is 3,523.46. Okay, good. So this scrap value will be transferred to the scrap account. So you have abnormal gain. of the value of the scrap is 90 cedis. That's 90 cedis. Okay, that's 90 cedis. That is 150 at 0.60. That gives us 90. Good. Then the actual normal loss is for the both periods, for both process 1 and process 2. For process 1, the loss was, the normal loss was what? Was 300 at 1 cedis. 300 at 1 cedi. 300 at 1 cedi. So see process 1. We have 300 at 1 cedi, giving us 300. And process 2, we have 450 at 0.6. 450 times 0.6. That gives us 270. Okay, that gives 270. Okay. Okay. So that is the process 1 and process 2 losses that have also been brought here. So at the end of the day, we have to balance of the accounts. So at the end of the day, let's look at the amounts that we are going to send, or the amount that we are going to receive. So we have 75 plus 300 plus 270. So more or less, this acts as a disposal account. So we have 645, 645. So the difference, that's bank receivable, will be minus 90. That gives us 555. 555. Good. Good. So this is how this will look like. This is how the process account, the scrap value, the abnormal loss and abnormal gain will be looking like. Okay, good. I trust that once you have time and you go through this, you wouldn't have any troubles. Okay, good. So we'll end here and we continue our discussions where we look at statement of equivalent unit, because the process it's not at all time that the use put into the process will be completed. There will be some element of what work in progress. How do we value the work in progress at the end of the day? Okay, now our next session, we'll look at that and look at how we demonstrate the principles there as well. Great. On this note, do enjoy the rest of the day till we meet again. Bye.